It looks like we have a wash sale rule question. Someone wants to know, how does the wash sale rule work and how can I use it to my advantage?
So I've got two ways to use it to your advantage. So the wash sale rule is, so let's say we just had that same scenario. You inherit $100,000 worth of stock, you sell it, and then 15 days later you decide, you know what? I actually want that stock. I think it's got a good future. I'm going to buy it back. If you do that within 30 days, then it's like the sale never happened. That's what a wash sale is. It's like it's a wash. We're canceling out the purchase, we're canceling out the sale and then subsequent purchase, and we're collapsing them into a single thing so that it effectively never happened. So this bites day traders a lot because they're buying, selling, and the brokers keep track of all this and say, okay, did you buy and sell the same thing within 30 days? Yes, you bought and sold the same thing within 2 hours. And so all these trades might be canceling out when it comes to tax reporting. That can be an enormous problem for people sometimes. But that's the basic idea, is that you cannot buy back within 30 days and have the sale that you started this whole 30-day period with count. Where it comes in is, most often anyway, is tax loss harvesting. So tax loss harvesting is a strategy where if you have gains that you've sold off throughout the year, then usually towards the end of the year, you'll look at your portfolio and say XYZ stock is down, $10,000. So I'm going to sell that one, and that's going to reduce my other gains by $10,000. Now, maybe I still want to hold XYZ for the long term, but it's just down right now. So I have to wait 31 days at least. I actually recommend waiting like 34 days just to be sure with settlement, because there's 3-day settlement and stuff. And then if I buy it back after that, then my sale counts because I'm outside the wash sale window and I have reestablished my position at a new cost basis, whatever the cost is at that future date, and we go on about our way and we're able to capture that loss. So there is a relatively new service called FREC, F-R-E-C, that has elevated tax loss harvesting to an art form. I still haven't funded my account over there, to be honest, but this is something that I've been planning to do. What they do is they do direct investing. And what that means is that if you buy a mutual fund or an ETF, let's say the S&P 500, that's the most common one. If you buy the S&P 500 ETF, you're buying a single thing that represents ownership in those 500 other things. What Freck does is say, no, it's the modern age. We don't need to do that anymore because we have computers that can control all this stuff. So what Freck does is it actually takes your money and buys the 500 things directly and weighted according to the index and all this kind of stuff. And over the course of time, they will sell stuff. And they will sell things that are in losing positions in order to capture that taxable loss and build up your tax loss harvesting. And they will automatically wait the appropriate amount of time in order to buy back into those issues so that you don't trigger wash sales. So it's a really cool platform. And again, I have not funded my account, but I do have an account in there. So that is something I will be doing over time. And what it does is that it basically makes your eventual sale of different things either more tax efficient or tax free because those losses just build up and up and up. It's a really cool piece of technology and a great example of how the things that we used to do manually are just being, what's the word, outdated, or I don't know what the word is that I'm looking for. The mutual fund exists and the ETF exists because it makes ownership of more complicated structures easier. But if you can just direct your computer to buy those other things anyway, you're cutting out the middleman to a large degree. It's pretty cool stuff. I
So
will.
this sign. So we have a Puerto Rico question.